Okay, good morning. It feels like a long time since we've been together. Class with a couple short announcements. First of all, the URL for class have changed depending on which class you catch. You're either the morning class or afternoon class. So that's pretty straightforward. Next. If you have an Android device, this was pretty exciting. I'm an Android person for the moment, and this was exciting. They updated the app, I think, Friday or Saturday, so now the newest versions of Android are supported. So that's good. Okay, and then, we are going to start to be like our first real class. There's no lecture per se. You watch the video lectures and done the video quiz by tonight. Now, what we're going to do in class today is everything we do in class is based on the video lectures and the chapter. So in any normal week, you're going to be watching the basic concepts doing in class. So, for example, we're going to start today with a false question or yes/no question, I guess it is. So, you're on a device. The first question, all corporations must use the calendar year as their accounting year. So true or false, yes or no. If you click in, we're going to be clicking in. And I'm going to go silent for a minute so people hear. Okay, on this one, why don't we go ahead and put up the answer and then put up the poll? The answer on this one is false. Okay, and let's see what kind. Okay, the answer is false. The reason it's false is a corporation can use any 12-month period as a year. It determines the year that makes most sense for it. For example, Kent State doesn't have a calendar year for its financial statement. It has a year that goes July 1st, 30th. And the reason we do that is because if we cut it off in the middle of a year, that wouldn't make sense. So a corporation or any entity picks the year that makes sense for them. A lot of retail stations have their fiscal year end January 31st. Why is that? They sell a lot of stuff for the season, and then people bring it back in January and off at the end of December. That's going to have some stuff in January for December. So corporations will pick a period, a year that makes sense to them, and sometimes it's really weird, but sometimes corporations use a 50 year, so it ends on like February 1st or February 8th or something. So you can pick what they do, but then they stick with it. So once Kent State made that many, many decades ago to go with the July 1st to June 30th, they stick with it. So they don't change. So we have a calendar year that's January through December. Corporations pick their fiscal year, which is what their year, it can be anything, but then they have to be consistent and stick with it. Okay, we have one more. Okay, from reading. A corporation must pay dividends every year. True or false? Yes or no? Okay, why don't we display the answer and then the poll? Okay, a corporation must pay dividends each year. That is absolutely false. A corporation never has to pay any dividends. A corporation only has to pay a dividend when the board of directors declares the dividend. Until the board of directors says declare a dividend, it's very formal action. They don't ever have to pay a dividend. Now, why corporations pay dividends and how much they pay, that's a whole lot of theory goes into that beyond our scope. But just know a company never has to pay dividends. Only when the board of directors declares a dividend do they have to. Yeah. Okay. So let's start. So today we're going to do several homework problems. This is the other half of Chapter 1 homework. So we're going to start with short exercise 1-10. This is in your book. And we're going to walk through how we do. Okay, so short exercise 1-10. You will see this exercise in your homework for this week. It will have different numbers, different names, but be the same thing. So we're going to walk through several homework problems today. So this first one, they began 2012 with total assets of $100 million and ended with $190 million. During the year, they earned revenues of $97 million and had expenses of $26. They paid dividends of $16 million. Notice that, so this is a housekeeping deal. Notice that they're referring to millions without the 6 zeros, just as the word millions. Don't put 6 zeros in the answer. You kind of follow what's given. So if I refer to million, if I would have to input 100 million somewhere in this problem, I'm going to put in 100. Okay, so go with how they're putting it. By the way, in my accounting lab, if you ever have any doubts about how to enter your numbers, click on the Help Me Solve This. Just go click a couple times and you'll see it'll be pretty evident you don't want the 6 zeros in this. If you put 6 on when you're talking about, when it says million, you're actually talking about what's bigger than trillion. Trillions? Is that a trillion? 6 zeros would make it trillion. So it is a big deal. Okay, so what do we do? I like to read the last sentence or two. And what we're doing, we're preparing the company's income statement for the year ended December 1st, complete with an appropriate heading. So what we're doing today is we're going through very, very basic financial statements. These are the most basic statements we can get. This one is an income statement. So this statement, not only will it help you on your homework, but it's going to be a model statement. So if we have questions about income statements, we know we've done an income statement. So the first thing we do on any statement is we have the heading. Every statement has headers, okay? So let's talk about it. Every heading for a financial statement has 3 lines. You pull up an Amazon financial statement or you look at anybody's annual look at a financial statement, it's going to start with 3 lines. Every one of them is going to start with that. The name is that the name of the company is the very first line. Always going to be the name of the company. Okay? So this one's split second. The second line, and it does matter what order they go in. Okay? So it's always going to look the same. So much of accounting is based on consistency, and part of that is to help you as a reader be familiar with it before you really even dive into it. I know as a reader, I open up a statement, the very first thing is going to tell me what company I'm looking at. The second thing is going to say the name of the statement. What statement is it? There's 4 main statements we look at in here, okay? So we have, and they're done in order, and today we're going in that order, so we start with the income statement, okay? The income statement is how we did, period. Now, the third line down is the date line. The date line can be one of 2 ways, and it's dependent on which statement it is. With an income statement, how did we do this last period? So it's based on a period of time. This is for a year ending. You would not have an income statement for December 31st. That would imply that you're showing what happened on December 31st. And that wouldn't make any sense. So an income statement is always for a period ending. So it can be quarter ending March 31st. It could be for a month ending January 31st. For whatever period of time, that income statement is going to tell you, the reader. And it makes a huge difference. In your own company, if you're looking at an income statement, it makes a huge difference to know whether that statement is for a month or for a quarter. Okay, so then also we have that little off to the side. It says it's in millions. Okay, so that's telling us we don't want to put all those on there. So this is every statement we do starts with, okay, so we have the name of the company, the name of the and the date. And in this case, income statement has to be for a period ending. Okay? So then next on our income statement, the first line of every income statement we do will be revenue. It'll either, now, like anything else, there's a couple for it. In this one, we have revenues, and that's its most basic format. You can also see sales, okay? And you can see sales revenue, so you get a combination there. So we've got revenues, sales, sales revenues, some combination of those words. That is the first line of every income statement. And when you think about if you had a company and you were selling things, your sales go first. Okay, and remember, these are very, very basic, so we'll have other things that go in them later, but right now we're just looking at this overview. So we have revenues. First line of every income statement, the content of it, revenue. So there's my 97 million. Now I got my 97 million from up in the exercise, and it says that they earned revenues of 97 million. Okay, so the second line of every income statement are expenses, and that's also given up in the top where we have 26 million. So I have expenses. Okay, now expenses are going to take a lot of different forms. We're going to see expenses, and maybe even today, next week. The first expense here is typically cost of goods sold. But here we're just going with this basic overview. What's the idea? An income statement is always going to be revenues minus expenses. That's how it is. We can call it sales minus expenses, same difference. But so we have revenues and expenses. Now, a couple things on typically, the first number in a column has a sign in front of it, okay? And this isn't stuff you're going to be, the dollar sign, these rules are not things you're going to be touching on. My accounting lab doesn't care if you put a dollar sign or not. It's fine. Don't put a dollar sign as a rule of thumb. But I'm just telling you, when you look at a statement, these are not random. So the first one, dollar sign. The second one below that doesn't usually get a dollar sign. If you put dollar signs on a single number, it gets really cluttered looking, so we've developed these conventions. The next thing we're going, and then we draw a line, revenues minus our expenses. A single line says, here's a subtotal of everything above here back to the last subtotal. So then our very next line in our little income statement is net income, okay? Okay, net income is revenues minus expenses. Okay, now, a couple things to note. 97 million minus 26 million is 71 million. Notice we do not put a minus sign in front of expenses. We do put parentheses around them. Every user of a financial statement will know that expenses are subtracted from sales. So we don't put a minus sign in front of it. It's just not done. Because it is possible to have a negative expense. So if you would put a minus sign in front of that, that means something different. So revenues, expenses, equals net income. Now, net income has a double underline under it, and that says we're done with this statement. We're not adding anything to it. And then it has a dollar sign in front of the 71 because we typically put a dollar sign after we have a subtotal. Okay, those rules, I'm not going to test the rules for where the dollar signs go. I just want to say that this is not random placement typically. So our statement, basic income statement format, is going to look like this. We're going to have revenues minus expenses equals net income. We start the statement with the header, the 3 lines of header, and a statement, an income statement is for its ending. Okay, now notice in the column that we had lots of other numbers given to us. We had total assets given to us. We had dividends given to us. We don't use every single number, just like in, we do not use every number that's given to us. We pick out the numbers that we need. So that's part of this, is distinguishing what's important. Okay, so another question. This one should be pretty straightforward. Net income, how do we compute net income? Is it A, revenues and expenses, or revenues minus expenses minus dividends, or is it B, revenues, expenses, C, revenues minus expenses? You can answer not in the chat window, in the poll. Okay. Yeah. Yeah, you have to give us a minute to put it up, but just wait. So, okay, C, revenues minus expenses, D, revenues minus expenses plus dividends. If sound's breaking up for you, that is a function of your internet. Okay, note that this is a good time to this. If sound's breaking up for you and you're on, if you're not in this room and you're on a computer, you can call. There is a toll-free number you can call to get sound on the phone, and that will take care of any phone issues. And you can always chat with Brian about the number, right? Okay. Okay. So again, you can call using the teleconferencing option. Yeah, so if you're on a laptop, you have the option of calling in, and Brian will put the number in the window. Are you good on that? Okay. Okay, what's your answer here? C? Okay. Okay. Right. So go ahead, display the answer. I'll display the answer. Okay. Okay. It is revenues minus expenses. Something to note, Okay, so we're back?
Can you hear now?
Yes, somebody. I heard somebody. Yeah. Okay, so not a big deal. Okay, so now on this one. Okay, so again, dividends are never subtracted from to get net income. Dividends are a return of owner's equity. Okay, so we can advance then? When total expenses exceed total revenues, the result is there's no sound right now because I'm walking around the classroom. Brian will tell you when I start talking again. Okay, let's display the answers. Okay, and so when total expenses exceed total revenues, our answer is going to be a net loss. Okay, so if revenues exceed total expenses, then that's where we have a net profit. But when we have expenses greater than our revenues, that's a net loss. So we have a net loss, net profit. Okay, so let's go back to our next statement. So the first statement we do is the income statement. So then we go on to our next statement that we prepare is the statement of retained earnings. Sometimes we refer to it as the statement of stockholders' equity, but it's one of the equity statements. So we start with the income statement. We compute our net income. Next one to be prepared is the statement of retained earnings. So we're going to walk through this. Notice that they gave us a bunch of data, but I skipped to the last sentence that said, prepare their statement of retained earnings. So the first thing we're going to do is we are going to put up the headings for the statement of retained earnings. So first, every statement starts with the name of the company. The second line is the name of the statement. So we have Cell Phone Corporation, we have statement of retained earnings, and then the third line is the date line. Now the statement of retained earnings is like the income statement in that it's for a period of time. Okay, so we have the name of the company first, we have the name of the statement next, and then the date. Now again, statement of retained earnings is for a period of time. So this is for the year ended. So, and again, we're doing millions, so we'll go on. The first line of this statement is the beginning retained earnings. I don't have the word beginning there, but that's what it is. The beginning retained earnings for the year December 31st, 2012 is the retained earnings as of the end of last year of 2011. If we end retained earnings on December 31st with $290 million, that's what we start the following year with. So that very first line of the exercise says they began 2012 with retained earnings of $290 million. So the very first line of retained earnings statement is beginning retained earnings, $290 million. Okay. Now, the next line of the statement, we actually have to use net income. We have to compute net income. So what I've done is net income is revenues minus expenses, right? We would have just prepared the income statement. So to get our revenues minus our expenses, our revenues during the year, they told us were $360 million. $360 360 million. Our revenues, our expenses are 250 million. Okay, so our net income then will be the difference between those two. Went on for a minute. So our net income is 110 million because we have the revenues of 360 million. We have the expenses of 250 million. So our next line, we're going to have the things I've circled are going to go away. Our next line, we're going to have our net income. Okay? So our net income, we're going to add our net income. Retained earnings is like a running total of everything we've made to date. So we're going to take our beginning retained earnings, add the net income that we earned this year for that year ended December 31st, 2012. And then what we're going to do is we're going to subtract out dividends. We said dividends are not on the income statement. Dividends are on the statement of retained earnings. The statement of retained earnings is a running total of everything we've made to date less the dividends we've paid out. So this is a case where we do subtract out dividends. When you see parentheses around a number, it means it's negative or being subtracted out. In accounting, typically we don't use a minus sign, we use parentheses around a number to show it's negative. Okay, and then what we do is we have a total then. So we're going to take our retained earnings of 290, add our net income of 110, and subtract our dividends of 44, and we get our ending retained earnings of 356. It depends. The question is, do we use the add and the less when you prepare a statement? Like you're talking about preparing one in real life?
Yeah, like is it just going to say net income?
It depends. Companies can do it different ways. That's not dictated, so it doesn't. Add doesn't necessarily need to be there, and less doesn't necessarily need to be there. They're here just so I could show you what was going on. Yeah. Okay, so something to note so far. So we've done income statement, which was as for a period ending. We have retained earnings, which is for a period ending. Our next statement that we do is the balance sheet. The balance sheet is the one statement that is as of a certain date. That's our one of four. Out of the four statements we're doing, one statement is as of a one particular date and time. But this one is year-ended. So you absolutely need to know of the four statements which ones are as of a certain date and which ones year-ended. So we've got three that are for year-ended and one that is for a particular date. Now we're going to do short exercise 112. Okay, short exercise 112, we're working our way down. I look at the last sentence to determine the last little paragraph what they want me to do. They want me to prepare a balance sheet, okay? And we have to use the accounting equation to compute retained earnings. So what we're going to do here is accounting equation to compute retained earnings. Remember we said that the accounting equation is assets equal liabilities plus equity, okay? So that assets equal liabilities plus equity, we talked about that last week. Now, equity is composed of two things. Equity is composed at this most basic level of common stock and retained earnings. We'll add other things in later, but for right now, equity is common stock and retained earnings. This problem tells us that it doesn't give us retained earnings, so we have to calculate it. So what I'm doing here is I'm just saying, okay, my accounting equation is assets equal liabilities plus equity. I know that equity is common stock and retained earnings. So my revised accounting equation, which means absolutely the same thing, is going to be assets equal liabilities plus common stock plus retained earnings. Okay? So we haven't done anything fancy here. We're just looking. They've given us all these other numbers, and we have to solve for retained earnings, so we need to separate it out. When I said that we're going to be using the accounting equation all semester, and this is an example of how we would do that. A lot of times you look at earnings releases or information from companies, they don't give you every number, but you can back into something that you need. Okay, so that's the basic formula in words. Okay, so I filled in some numbers here, so I've done a two-step process. Assets. In the problem, I've circled them in purple. The assets, it tells me, as we'll start reading, the company has cash of $12,000, so that's an asset. So what I'm doing there is I'm putting down the assets under the $12,000 under assets, reading receivables of $8,000. Receivables, accounts receivable is an asset, so I'm going to use that as an asset. Then the next thing, inventory of $44,000, that's also an asset, so I'm going to add that to assets. And then the equipment totals $88,000, that's also an asset. So all the numbers in purple, those first four numbers on the bottom there, those all represent assets. So then moving on to liabilities. Liabilities, we have accounts payable $13,000 and long-term notes payable of $80,000. So those two items together are our liabilities. There's no other liabilities listed up there. So I've not completed the equation yet. I'm just doing assets and liabilities at this point so we could see where they came from. Okay, so I still haven't dealt with the numbers in red yet, the common stock and retained earnings. So now, common stock, it tells me up above, is $15,300. I didn't circle it. It's the last sentence of the first paragraph. So common stock is $15,300, and then I don't know what retained earnings is. So all I'm doing at this point is I'm saying, okay, now I know what assets are. If I add all of those up, if I add the liabilities up, I have the common stock, I can solve for retained earnings. Okay? So when I do that, when I rearrange the numbers to solve for retained earnings, I get 43,700. So I'm going to take all the assets, all the purple numbers, and then subtract 13,000, 80,000, and 15,300, and I come up with 43,700. Now I haven't really even started the problem yet. All I've done here is I've gotten my retained earnings. So this 43,700, it's a number I need to calculate ahead of time. So now what I'm going to do, the requirement is actually to prepare the balance sheet. Now a balance sheet is a list of everything we own or owe at one particular point in time. So I'm going to leave this screen because I don't have room to do the balance sheet with all the stuff on. But the takeaway here is that retained earnings is 43,700. So what we're going to do now, we're going to actually work on what the problem calls for, and that's to do our balance sheet. So balance sheet, it's another statement. So it starts with the name of the company. Second line down is the name of the statement. So these statements are all very standard. Name of the company is first, name of the statement is second, And then the third line is the date line. The balance sheet, you could think of it as a camera. It's a snapshot of one point in time. When we have a balance sheet, we're listing the first thing on the balance sheet coming up, by the way, is cash. Cash is always first on the balance sheet. Always, always, always. So we have cash first. That's a picture of how much cash we have at December 31st, 2012. It's not a picture of every cash balance from every day. It's a picture of what's in our bank account right now on this date. It's not the cash from yesterday. It's not the cash for tomorrow. It's what's there this date. So this is the one statement of the four formal statements that is as of one date. Every other statement is for a period ending. By the way, these headings, the name of the company, the name of the statement, and the date, these are easy points for you to pick up. On your exam, you're going to have homework exercises, not all of them, but selected ones on your exam in My Accounting Lab, just like you do the homework. And those are easy points to get. You don't have to do any computations. You just have to think, well, the first line is always the name of the company. Second line is always the name of the statement. And then you've got your third line, which is your date line. And you have to remember, balance sheet is one date. The other statements are a range of dates. Okay, so we're starting with assets, okay? So assets, we've got some real basic ones. We're going to keep adding ones each day in class. And so we're going to start with the ones they gave us here. They gave us very limited assets. They told us we had cash of $12,000. We have receivables of $8,000, inventory of $44,000. Now we have a distinction with assets between two types of assets. We have current assets and we have long-term assets. Current assets are all assets that are going to convert into cash, basically, or be used up within a year. Okay, so balance sheet. Our balance sheet actually can go down in one row. You can have it all so very long. My screen's not big enough to put the whole balance sheet on, so we're going to go on to another screen in just a minute, but we're going to finish the assets first. So a balance sheet is a visual representation of the accounting equation. So if you want to think about the three sections of a balance sheet, you have assets, equal, and then you have liabilities and equity, and that is exactly how a balance sheet is presented. So we're starting with assets. Current assets are first, and then long-term assets. So next, the long-term asset, equipment, we would not expect that to be used up in a year, so equipment's always a long-term asset. Okay, so we get total assets. So here's a good case where we are adding cash plus receivables plus inventory. So we're adding the 12, the 8, the 44 to get 64,000 of total current assets. Then we have equipment, which is 88,000. So we have another single underline. So we add the 64 and the 88, and we get total assets of 152,000. Our accounting equation is assets equal liabilities plus equity. So we are done with the asset section. So we do a double underline. This 152,000 is our total assets. What do our liabilities and equity have to equal? 152,000, right? So we already know what the other half equals, okay? So we have assets and then liabilities and equity. So what we're going to do now is we're continuing with the balance sheet. We're continuing with the balance sheet, but I don't have room here, so we're just going to go down, move